uh, you know, the HNI activity now is a very important and a very commanding factor in the way how some of the semi-mid cap and semi-large cap and mid cap stocks are moving. Vinay Khattar, head of Edelweiss Investment Research, joins us. He's got the pulse, the understanding, and also a sense of what the HNI crowd on the street is doing. Vinay, fantastic to have you back, and thank you for joining us. So, what are your HNI clients doing, Vinay? Are they looking at riding the momentum, or now the smart guys are looking at booking profits when there is outright greed and euphoria?
Hi, morning to your viewers, and thanks for having me back. So you see, broadly, a lot of HNI, the professional investors, so to speak, have participated pretty healthily in this rally, which has been playing out for now many, many months. At this point in time, people who have booked profits in anticipation of correction are now quite out of the market, and that's causing a lot of pains because market, despite giving a lot of signs of being overvalued or getting stretched in the near term, is really not correcting, so to speak. So are people over leveraged? At this point in time, no, the lever is slowly coming down. But are people wanting to exit out of the markets or to sit in a lot of cash so that they could get better opportunities going forward? That is clearly not what is happening. In terms of the overall market sense, our sense is that a kind of a healthy correction is overdue now. We've had one-way rally moving on day after day, with Nifty touching daily highs, mid cap and small cap indices moving up very, very vigorously. So if you were to look at the overall global scenario also, Hang Seng has had probably one of the highest absolute returns in last 50 years. It's up almost 11%, and with that kind of a steep move which you are seeing in Asian markets, Dow, a kind of a correction is almost anticipated, and that should probably play out over next 1 to 2 months.
Vinay, can you give me a sense of what has been the tone of activity at these levels from HNI investors? What are the natures of stocks they are buying? Are they tilted towards leverage positions? Are you getting a sense that there is demand in margin funding? I'm just trying to understand, Vinay, from you, is the nature and the level of commitment which HNI investors are doing?
So quite clearly, the commitment to the markets is definitely not coming down. Are we at an all-time high leverage? No, we are not. We are almost 20-25% lower than all-time high leverage. But are people beginning to exit the markets in anticipation of sharp fall? No, that is what is not happening. In terms of participation in the stocks, there are a few themes which are still playing out. One is overvalued mid caps are slowly being exited, and people are happier playing large cap IT and pharma at this stage. We are seeing that as a trend beginning to play out. We had ourselves come out with a mid cap IT basket about 4 months ago, which has seen significant participation. Those stocks are almost up. The basket is up about 40%. So that's another kind of trend where a lot of professional investors who also track just the prices and charts participated in this IT trend pretty early and have given very handsome return, whether it is Tata Elxsi, NIIT Technologies, or KPIT, and so on and so forth. Second big trend that you find is that globally, the global plays where you are seeing value migration happening to India, whether that is in chemicals or auto space, that is getting a lot of professional investor attention. People are happier buying a Motherson Sumi or a Bharat Forge even at very high valuations because you see value migrating out of a lot of other countries into auto ancillary space in India. And similar plays are happening on chemical. Again, consumption is another particular space which is attracting a lot of attention because consumption has really not done too well in last 5 to 6 months. You've had rallies on metals and road sector stocks and so on and so forth, but consumption per se, whether it is milk, branded apparel, or even FMCG, to a certain extent, the participation has been a little less broad-based. So that is another area where we are finding people building up their books with an anticipation of rally happening over the next 6 to 12 months.
Right. Vinay, are you encouraged by the earnings report you've seen thus far? I mean, comparisons are being made that, same quarter last year you had the GST impact, so maybe a low base has helped. But even so, guidances have been maintained, especially for a sector like IT. Pharma, in fits and starts, a little bit of change expected there too. We've seen some of the banks come out with decent numbers. Advances growth has picked up. That's where the concern was essentially that credit growth is lagging, and particularly on the corporate credit side, because I think retail credit growth had picked up quite phenomenally, and which is why you saw NBFCs gain from that advancement in trend. But do you see now things falling in place for those earnings beat to come in, and earnings moving into early double digit or mid double digit sort of growth numbers soon enough?
Absolutely. Our sense is that this year is going to be the year of the earnings. You've had PMI at 54 plus, touching all-time high. 8 core sector industries data, it's 16 quarters high. Rupee has been appreciating. So a lot of factors in terms of the global trust, the FDI coming in, and eventually all resulting in industrial cycle picking up, kind of playing out. You've had, as you rightly said, on the banking side, there have been quite a few surprises. The credit growth has actually been very, very pleasant. I mean, expecting double-digit credit growth, and a chunk of that happening out of corporate credit is a big positive, because if you were to look at even the last 3, 4, 5 quarters numbers, even if the credit growth was being reported, it was a lot of it was on the retail side. Now, for the first time, you are seeing that the green shoot on the industrial sides beginning to emerge, and one of the early factors is the corporate credit growth. Even on the demand side, you're finding that things are becoming better. FMCG has reported a very healthy set of volume growth. The entire pack has done pretty well, including Hindustan Unilever and so on and so forth. So the industrial capex, the consumption, and the overall growth on the lot of listed space, whether it is on the building material like tiles or road construction space. Road construction space has been very, very interesting. Look at the kind of order flows which are happening. Every other day, company comes in, every other company comes and reports a few hundred crores or maybe a couple of thousand crore of order book, and that accretion is going to be very good as it gets commercialized, and a lot of those numbers begin to flow into the bottom line. So 2018 is going to be year of earnings growth, and we must see it in the context that for last 3 years, Nifty earnings have been practically flat to moving between 0 to plus or minus 5%. Now, after this kind of a consolidation phase, the earnings growth are bound to do quite well. Our sense is over the next 2 to 3 years, you could easily see 18 to 20% CAGR on Nifty earnings, and it will be aided in no small measure by our external sector looking stocks like in IT and in pharma, especially with what's happened in US in last few months with tax cuts. IT stocks have done very, very well. You are expecting a big demand uptake happening in BFSI there. Even pharma, though fundamental, there are no immediate triggers, appears to be doing well. So overall, corporate earnings, both on the domestic as well as on the international side, for the Indian players should begin to emerge.
Since you touched upon IT, is it time that the laggards caught up with the outperformers, IT, pharma, PSU banks?
So if we were to just pick up one by one each of these, you see PSU banks saw a very significant rally as soon as the announcement of recapitalization happened of about 2.1 lakh crores. You saw all of them run up significantly. Some of them have done better today with yesterday's announcements on the amount of recapitalization, with IDBI being a clear winner. But from this point forward, I think the number to watch out would be what is the kind of credit growth, especially on the corporate side. And our sense is that is going to play out pretty well over 2018 and 2019. So public sector banks which can control the NPAs would be better bets. But even on the private side, guys like ICICI and Axis, which have been clear laggards as compared to HDFCs of the world, could be looked at because they have significant corporate books, and that area is something where we are expecting improvement in next 12 to 24 months. Coming to IT, as I mentioned, is clearly being picked upon because of expectation of significant change in demand environment playing out in US, significant tax cuts. BFSI sector is expected to be one big winner in US, and that could have a very positive demand impetus for a lot of IT players. Yesterday, TCS became the largest company in India by market capitalization, almost becoming what 6.3 lakh crores, and beating Reliance to the #1 spot. So the sector is clearly getting positioned itself after a long consolidation to come back, whether it is mid cap or large cap IT.
Vinay, we would have loved to chat a lot more with you, but unfortunately running out of time in the thick of earnings. Cigar is set to deliver, but great speaking with you. Thank you so much.
Thank you.